We've talked on this program, Peter, in the past about the growth of private credit and private equity. It seems sometimes like the trees are growing to the sky. I know you've just gotten back from Miami talking to an MFA conference about portfolio allocation. Is there a point at which maybe we start not rushing forward in private quite so fast?
Yeah, I think we are at that point. I think that in the last 15 years, we've had declining interest rates, benign credit environments, and very low yields. And the place where you could get more yield was in the private space, particularly in private credit. And the place where you got more return in equity was in private equity. And a lot of that was in growth investing, venture capital. I think at this point, we have to be more cautious about those spaces. And the liquidity coming out of those areas that you invested in has slowed down dramatically. We know that there's a lot less M&A. We know there's a lot less IPOs in the private equity space. There are continuation funds being talked about in credit, so maybe your credit comes back slower than you thought. So I do think, we said this in the earlier session, is that yields in the liquid space have grown dramatically. And so if you're thinking about where you're going to allocate your next dollar, would it really be in that private space, or would it make more sense to actually be opportunistic in the liquid space and find a place to actually get reasonable yields with liquidity in that area?
So now weigh in here from the fixed income side. How does this play out in fixed income? Private credit, syndicated loans, liquid credit, how does it play out?
So basically, it is exactly true. For the last 15 years, illiquidity was almost sought after because liquid assets yielded so little. What I would say is today, with liquid assets, I look at high yield, for example, and even with the current yield compression, you are getting all-in returns of something like 7.5%. If you look at bank loans or floating rate, which is a little bit even, it's very short duration, it's looking good at around 9% or so. I think that private markets are going to need to give a significant premium for the illiquidity in a period when liquidity starts compressing as central banks start ending their periods of QE and so on. So that's one element. But against this background, there are many institutional investors who quite like having assets which are not marked to market because you don't see the volatility constantly, right? So I think there's a bit of a trade-off there. Nonetheless, with liquid markets, liquid fixed income markets yielding as well as they currently are, I'm very optimistic about fixed income over the next few years relative to last decade.
I think there's some risk in not marking to market assets at the end of the day. I fully get that I don't want to see my assets go up and down. I fully get that it's nice to smooth them. But at the end of the day, if you actually don't know what the values are, that's not exactly a good place to be. And I also think that we've had very few periods in the last 15 years. We've had an extended period of time when asset values are hard to determine. We've had short reductions and very rapid increases. But if you go for 2 years where your assets are kind of difficult to value, that's a tough place for any fiduciary to be.